lesson for all of us and including your audience here, that this whole myth about large cap doing well is not really true, right? Quality lies across the market cap spectrum. And I think Sushant gave out the numbers, and that's what we find as well. And to start off with, our strategy is market cap agnostic. It's not like we start off with the large cap. Ultimately, we look for the quality parameters that fulfill our investment strategy. It so happens that some of them are skewed towards the larger companies, and I think we'll come to that explanation as to why the larger companies are getting larger and larger. That's a global phenomenon as well.
True.
It's not just in India. Consolidation for various reasons is driving the dominant companies to continue to take market share. Absolutely. And I think if your question is that trend is here to stay. You will see the dominant companies take more and more market share going forward. The guys with the competitive advantages, the environment is so favorable for them because we're becoming a unified market across the country, either because of breaking down of barriers from telecom networks to road networks to GST, a unified market. And technology disintermediation means that the national guys will wipe out the regional guys fairly quickly. So various reasons, the dominant guys can become larger. But having said that, in the market cap spectrum of mid cap and small cap as well, you will see champions or dominant forces, albeit there are dominant forces in a smaller industry. Their industry itself happens to be niche, and hence they are mid and small cap, although they are market leaders in that. If you can identify these market leaders, not just leaders, but dominant market leaders, almost a quasi-monopoly, irrespective of the market cap, they'll do well. And the second aspect I'd like to emphasize, again, for your audience benefit, what Sushant mentioned is the low churn. I think it tends to be very underappreciated. The cost of churn can be fairly significant, right? So our churn is also in single digits, roughly about 5%. I think the industry average churn is 50%. Just this difference can add 100 bips to your outperformance. It's as high as that. Often when you pay a broker 10 bips, you reckon that, how much difference can it make? But if you keep churning, remember, not just the brokerage, there's an STT on top of that. There's also price impact, particularly if you're dealing with small and mid cap. On top of that, capital gains tax, whether short term or long term, all of it adds up to a large number. So I would reckon the 2 points that Sushant mentioned, forget about market cap. Focus on the dominant players in each of these market cap spectrum. And second, stick to low churn, because dominant forces don't change that frequently.
I reckon, and maybe I'm wrong, but in terms of, there are different strategies, of course, and as Bhaven has a strategy wherein maybe the number of companies in his portfolio are much higher. Your strategy might, and correct me if I'm wrong, Bhaven, but your strategy has been converse, wherein the number of companies in your portfolio are much lower.
Absolutely.
And you have a fairly overweight position from a market cap criteria into not necessarily the large cap space. Now, again, are you looking for companies which are leading the particular spectrum and therefore the oversized bet, or you're not necessarily looking for a dominant leader within a pocket?
So the best scenario is obviously to look at the dominant company. For example, we call our portfolio all-star. And the definition of an all-star is typically for a company to do well across market cycles. So obviously, when we research, we spend at least 20 years to understand how the company has done well, including, say, 2008-9 meltdown. For instance, how the financial position, how the operational position of such companies have been. Just to add to what Pramod as well as Sushant has alluded, we obviously look for dominant companies. But what we've also figured out intuitively is that, and seen through with the data as well, is that companies sometimes, get lax, especially the leaders. And it is the second company which kind of has a faster growth, and they end up being far better wealth creators. For instance, we would also want to add that we actually focus on market share gainers, right? So to give you a couple of examples so that your audience can relate to it, think about the difference between a Castrol and possibly a Gulf oil lubricant, right?
I just want to interrupt you out here. Viewers, please remember, any examples that are spoken out here are only for illustrative or education purposes. They are not, strictly not recommendations from any of our guests. Please make your point.
So thank you. Castrol has been a dominant lubricant player for a very, very long period of time. But if you see, over last 20 odd years, the focus has been largely on profit margin preservation at the cost of volumes, for instance, right? But if you see, Gulf oil lubricant on the other side has continued to gain market share and continue to drive volumes which are almost 3 to 4 times the industry growth, and therefore has been a great wealth creator. Over a long term, please understand that the returns are going to come from obviously what the company's underlying earnings are, and that's going to exactly match what the shareholder returns are. So therefore, the only caveat is that we obviously want to look at a dominant company, and many a times the dominant company ends up getting market share thanks to technology and all the factors that Pramod alluded to. But sometimes you would also have a second company or the second in the race, actually doing better than the leader.